All right. Happy Saturday, everybody. Going to do the COT report. Didn't get to this as soon as I wanted today, but life gets in the way. All right. So if you're new to the COT, this is a report the government asks that the institutions provide the data for on Tuesdays. The government gets that data on Tuesday evening, and then on Friday after the close, the government comes out with their report. Now, if you're thinking that this doesn't have any value because of how old it is, then let's kind of get that out of the way. It takes institutions weeks and weeks, sometimes months, for them to unwind a position and or build a new position. So continuously coming back to the same data week after week and reviewing this data for changes and looking at where they're going with their money gives us an idea going forward of what we may want to be doing, right? We're looking for a capital rotation. We're going to look at the VIX. We want to see where they're putting their money or where they're taking money out, on the idea that they won't go to cash. It actually costs them money to go to cash, but they will capital rotate, right? They'll move out of emerging markets and maybe go, heavy in pharma, or they will, move out of American markets and move heavier into European markets, right? So they're always on the move. They're always building or unwinding a position. And on Friday night after the close, this is our opportunity to kind of get a glance at what they've been doing. Now, I've missed this report for 2 weekends in a row. One weekend I had a family reunion, and the next weekend I had some construction at the house that I was doing. And so I haven't seen this report now this is the third week. It's been that long, and we're going to look on the charts and see how much has changed in the last few weeks. And then we're going to go over to, look at the S&P and the Nasdaq, maybe a couple of these things on their charts as well. So we want to start off with the S&P. Now, when we're looking at the S&P, you can see that there are two different ones here. This is the S&P 500 index. These are the large futures that really, most of us would never trade anymore. And then this is like the ES down here. And if you ever are unsure, when you click on it, it has the value, right? So we'll just open this up. You'll see what I'm saying. Here it's saying that it is $50 each. Well, we know that the ES futures are $50 each. So we know that we have the right one. If you're ever in doubt, that's a good place to look. What is its cost? Because if we click on the other one, just to show you, you can see that this one is $250 a piece. Well, that's not the right one. Let me rephrase that. Right or wrong isn't in question here. It's which one did you want to look at? Now, I've reviewed both of them back to back many times. And what I've noticed is they're very, very similar to each other. But they do represent different things. And if I'm not mistaken, I believe these are actually being phased out of the market. All right, so they're actually doing away with these, I believe. But either way, this does represent a large amount of capital. But, we're already here. Let's just go ahead and scroll down and discuss the three main groups on here. Really only two that we're going to focus on. Now, if you've never seen a COT report, this one that we're looking at isn't the government-produced COT report. That one is almost like an Excel spreadsheet. It's just numbers. Very unimaginative, just dry coarse, hard to work through. This has at least a little bit of context, right? We got some color. It's got a little bit of structure to it. You could go and Google the government COT report and you would find that. And you can go to places like barchart.com. They do the COT report. There's actually a lot of places out there that have that. But we want to go here. I'm on tradingstir.com. You can go there for free. It doesn't cost you anything. There are a number of groups here, right? Now, dealer intermediary. Let's just kind of discuss institution for a moment. When I was newer to trading, it always frustrated me to hear somebody live streaming and talking about the institutions. Oh, the institutions are going long. Oh, they're going short. They're doing this. A lot of times I would hear two different people say the institutions were doing two different things. No sound. How about that, homie? Can you hear me now? Órale, güey. Check, 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 check. All right. Had the sound on in Restream, but I did not have the sound on in the Discord. All right. So we're on tradingstir.com, and we are looking at the S&P, the large one, the one that I honestly believe is going to be phased out soon, but this is the one we're looking at. If you wanted the actual ES, that would be this one. And if you're ever unsure of which one, just check the price tag. An ES futures contract is $50, but that's the ES mini, not the micro, the mini. The full ES is a $250 contract. Nobody really trades these, at least not us retailers. So 3 groups here are worth looking at, kind of. We're really only going to focus on 2. It always frustrated me when I would hear people streaming and they would talk about the institutions. And they would say the institutions are going long or the institutions are going short and the institutions are buying or doing this and that. And sometimes they would literally say the opposite of what the other person was saying. One person would be streaming saying, oh, wow, look, the institutions are going long. And at the same time, in another channel, somebody else would be streaming saying, oh, yeah, look, the institutions are going short. Come on, man. They can't both be going in the same direction, opposite directions. Actually, they can. They actually can, because there's different kinds of institutions. And these institutions have different agendas, and they some of them even have different rules, things that they're allowed to do or not allowed to do, and things that they historically do and what they don't. So let's just kind of go through for a moment the ones that we're looking at here, and then the ones that we're actually going to use. Now, I'm not using Zoom anymore, so I'm going to have to get the old school pointer out. Give that a moment to wake itself up. There it is. Yay. All right, so the dealer and the intermediary, this group right here, this is their long side, this is their short side. Now, that's a little misleading because this is the sell side of the market. Think of these guys as the market makers. That's not technically true, but we need to put an image in it, right? So we can kind of wrap our head around what we're dealing with here. Dealer intermediaries, these guys aren't trading the market. They are what we get things from, right? They are providers. Large banks, dealers in securities. This is the sell side of the market. They're like market makers who make money on the spreads, right? Between the bid and the ask. So their size, their position really isn't something that we're going to need on a day-to-day and a week-to-week basis, right? Because it's not going to tell us anything. Now, the next one in line here are asset managers and institutions. Wish I could do straight lines with this because my handwriting is just horrible. I am not an artist. So these asset managers and institutions, and their long side and their short side, right? Now, there is the spread. We really don't need to get into the spread. what we want to focus on is, first, what did this group of institutions represent? And what did they do this week? And for me, I'm kind of interested in what they did in the last few weeks, because I haven't seen a report for a number of weeks now. Had a family reunion, and I put in French doors in my office last weekend. So that's 2 weekends in a row. I don't know. I'm really interested. So first, who are they? These are the institutions. When we talk about institutions, that's these guys. Pension funds, insurance companies, quote, street money or smart money, mutual funds. This is the buy side. Now, the other group was the sell side, right? This is the buy side of the market. Long duration traders. These are the guys that are getting in it and they're not letting go. They're going to hold and they're going to hedge when they need to, and they're going to always be in the market. It will cost them money if they go to cash. And nobody can go to the boss and explain that, right? Like, well, I was trying to save money, so I closed these trades and went to cash, and then it cost us thousands and thousands of dollars because I did that. So they're always in the market. But what they will do is they will reduce their position. They'll take profits like we do. They will hedge against their own position. That way they don't have to necessarily close any of their position. They can just reduce some of their risks. So let's take a look at what that looks like. And one of the things that I like to use to be able to grasp everything that's going on is the good old trusty calculator. Right now at the moment, asset managers are sitting at 234,500 contracts. I generally tend to like just round things. So 234,500. They increased their position this week, 5,592 contracts. So they were at 229 flat, right? You kind of just do the math backwards. They were at 239 flat, and this week they bought 5,592 contracts. They are 167 different traders, probably trading firms, institutions, different ones. And then at the same time that they increased their position 5,000 contracts, almost more than 5,500 contracts, they also increased their position another 4,000, we'll say 4.25. Why did I say increase? Well, if they take some shorts off of the table, then they've increased their exposure to the long side. So they reduced their hedge by 4.25, and then they increased their long another 5.5. Not bad. You add those two together, and you're very close to 10,000 contracts that they increased their exposure in the market. You would have to believe that they're not feeling the fear, right? They wouldn't be sizing up in the S&P if they were scared, right? They would be hedging up. And remember, this is before we hit the all-time highs, right? This was Tuesday. So what does that look like? Where were they in the last few weeks? Well, let's just scroll down here, call timeout. And we have this graph. And I know this looks junk, right? Hold on. Let me fix it. All right. Now we got this blue line that represents week after week of their position in the market. And we're going to kind of zoom in a little bit. And what we're looking for is this little dot. Because, it's not like a regular line graph or a line chart. Each dot represents another week, right? So there was a week, and then the next Tuesday went by and they reported again. And this was the change between weeks. And then another week went by and they reported here, and that was the change. All right. So the last time I was in here, we were running at around 170,000 contracts on asset managers. Maybe a little less than that, right? Because 1 week, which is Tuesday, the week I missed, and the other week I missed. So yeah, it's been around 163,000, and now we're back up to 157. We increased that exposure from around 150 to 157, right? And just kind of park my my mouse there, 157 something. So we can see that they really reduced their position. Since September, they've been taking money off the table, reducing their position size, reducing their risk, and this week they turned it all around. Took a good, solid move to the upside. Not extreme, right? We can even see back here in June, they took a healthy chunk back here. So this isn't like above and beyond the norm, but that's a healthy chunk. Almost like they were trying to reverse that last position that they had done, right? And they're trying to get back in line. So, okay, we got some context now. That whoever's trading in the ES from the asset managers, these pension funds and insurance companies and mutual funds, that they're not feeling the fear, and they sized up Tuesday before we made this all-time high. Okay. All right. Let's kind of scroll back up to the top here. And now let's look at this other group. Leveraged funds. Now, who are these guys? And what did they do? Now, leveraged funds, CTAs, speculative money, these are buy-side groups, but they're gonna run arbitrage. They're going to go short, go long. In fact, I've never seen them long. I've always seen them short. They'll actually attempt to make money in both directions. Asset managers don't do that. They'll never make money to the downside. They will never build short positions. But these guys, it seems like they're perpetually short in the market. They'll go long, they'll go short. They will unwind and rebuild new positions every quarter and every other quarter. When it comes to, like the way that they poo-poo on retail traders, and they say that, retail traders, we are stupid and we're scared or we're weak hands and we always get it wrong. Like, oh yeah, retail always buys the top and sells the bottom. And that's the way they look at leveraged funds. If we were to try to lump all of the different institutions into different categories, these guys, leveraged funds, they get treated on the street like the dummies, the ones that are selling tops and getting it all screwed up, right? That would be these guys. But is that necessarily true? I mean, that's just the way it's taught. It's the way it's presented. I can tell you that they're always short. At least since I've been doing COT reports, I've always seen them short. I've never seen them long. I've gone back and seen long positions in the histories, but they've never been long while I've been watching a COT report. So what did they do this week? This week, they reduced some of their long side by over 5,700 contracts. So they were at 50,000, right? 51, actually. They were at 51,000 long. And they took a lot of those longs off the table. And they increased their hedge by nearly 9,000 contracts. Well, if you add these two together, which we would want to do, because taking longs off and adding a hedge at the same time, that gave them an even more short position than they already had. They changed their position more short by 13,000 something, 14,000 contracts. That's a significant move. Let's go down and see how significant that is. So before I had the asset managers here, we want to turn on the leveraged money and turn off the asset managers. Oh yeah, look at that. That's a significant move to the downside. Now notice we're in negative numbers. When we were looking at asset managers, we had positive numbers, but now we have negative numbers because these guys are in the hole. They're short in the market, and they just upped that short game pretty significantly. They almost got to zero. Look at that. Last week, they only had 4,000 contracts short, and now they're at nearly 18,000 contracts short. So they significantly increased their short position in the S&P this week. Maybe they do always get it wrong, huh? Maybe. Now this ES is the one that we all trade, /ES, the S&P minis. Look at the size, millions. These guys are long millions of contracts. That's awesome. Very small hedge, right? And they took a lot of that hedge off. They were over 400,000 short hedging, and they took 21 off and added 27. Whoa, they changed their position quite a bit. So they added almost 28,000 contracts and took off 21. That's almost a 40,000 contract change long. If you're talking about a bullish move in the market, that would represent a lot of bullish bias. You would want to assume or believe that they had a little bit of bias there, right? I don't think I'd want to go long 40,000 contracts if I didn't have some glimmer of what was coming, right? So now they're sitting 785, 787 looks like, right around ish, 787. Not too bad. They took a good size to the upside. Not back where we were in June or July, where they have been working their way down since then. But they did a significant turnaround here. Not too bad. So let's go back up and flip to the other side. Leveraged funds. Orale. Yeah. So these guys, they increased their short position 43.7 while also increasing their short by taking longs off the table. Call it 29 and 44. 44, 54, 64, 70 something thousand. So you can see that they significantly changed their position here. Yeah. By taking 28.8 off the table, off the long side, that increased their hedge. And then they also increased their hedge by adding more shorts. So when we put those two numbers together, I'm going to just scroll down here. And we need to turn off the asset managers, but we got to turn on the leveraged money. And you can see we're on the negatives. Remember, the other ones were positive. These guys are net short, while the other side is net long. These guys increased their net short position significantly. Not the most we've ever seen before, right? We can go back on the chart and find bigger examples of that. But we can see that they decreased their position, or they increased their short by quite a bit. Now, they were aiming for zero, it looks. They got very close to zero last week. And then, well, the week before, right? This is this week. That was the week before. They got very close to zero. Now, remember, Jay, that this report is online. So you don't have to try to read my numbers. You can go to the website when we're done and review these in great detail. What we want to go through today is making sure you understand who these groups are: leveraged funds, asset managers, how we can turn these different settings on and off so that you can see the change in their positions, that you can understand that one is net long right now and one is net short right now. You can see where they were last week. You can see what they're attempting to do this week. And infer a bias from this. It would really appear that leveraged funds think the market's going down. they increased their short position. And they took a significant portion of their hedge off. They wouldn't do that, you would think, if they believed the market was going to continue this move to the upside. But remember, these guys get it wrong all the time, and they've been net short most of the year, I believe. The really cool thing is we can come down here and look. How long have they been net short this year? Did they miss the entire freaking rally? Right? You mean like, really? Did they since Corona? Come on. There's the zero line. We came into 2020. We got almost to zero here. And then they went back below the zero line. And they've been below the zero line since 2019. They've been below the zero line. So, why are we looking at leveraged funds if these fools were short through the entire run of the Corona rally? They represent a massive amount of capital in the marketplace. And, maybe on accident, they might actually get it right once in a while. Definitely want to see what they're doing. But while they are going short and increasing that short, I'm not feeling it. Another thing I noticed, when the market gets really negative, these guys try to go towards zero. Notice here they actually were above zero. Well, when was that? December of 2018. Now, I don't know if you guys remember 2018, but I do. October was the first time I'd ever seen a market hit a top and fall into a volatility box and then really fall right before Christmas. And then we had that massive after rally Christmas all the way out into the new year and all the way back up. It was a beautiful thing to behold. These guys were actually in the positive when the market was falling to its most extreme. So when they're going short, the market really seems to be going up. And here they are going short yet again in a time where everybody else is going long. The market seems to be going up. So remember the asset managers. They increased their long position by a healthy chunk. And this is all in the S&P. While we're here, a number to recognize is this open interest up here. 2.3 million contracts. And where's 1.1 million of that? Actually, closer to 1.5 asset managers. Okay, so this covers the S&P. We'll knock those off the table. And let's go look at the Nasdaq. So remember, we don't really pay any attention to the dealer intermediaries. That's the sell side. It's the market makers. Their position doesn't mean a lick to us. No reason to analyze them. Asset managers and institutional, these are your pension funds, your insurance companies, street money, smart money, mutual funds, the buy side of the market. They increased their long 10.5, it looks like, because if you take 2.7 that they added on the long side, and then the 8.7 they took off, we'll call it 8.8 because it's close enough. 8.8 that they took off of their hedge, they increased their long more than 10,000, right? They were long 65, 64 something. And they had, out of 64 long, they had over 50,000 short. So they were almost flat. And now they're going long a little bit heavier in the Nasdaq. Well, how much heavier is that? It's easier to kind of put it into context when we can see what their normal movement looks like, right? So we kind of come in here and we turn off all the other junk and we zoom in a little bit. The move that they made this week was from 13.5 to 25.1. That's a healthy move to the upside in the Nasdaq. You can kind of feel like they ain't got no fear here, right? They are reducing their hedge. They're increasing their long. And they weren't at zero, but they sure were getting close, right? Now, March of 2021, they got below zero momentarily, and back in May and a little bit again in May. But since then, they've been holding above zero, and they started to run back again in the first 2 weeks of September. They started that decline here, but they made significant change here. I'm really going to be interested in where they're at next week to see if we break through this level that they were right around that 30,000. And I'm a Nasdaq trader more than the ES, so I'm going to be very interested in their bias next week. But I like this change here because I wasn't feeling very good about them decreasing their net exposure in the Nasdaq. So let's roll back up here and look at leveraged funds. Remember, this is your CTAs. This is, speculative money, the buy side also, just like the other ones. These guys will go short, and honestly, I typically see them short. It seems like they're always on the wrong side. But they run arbitrage, and I really think that that has a lot to do with why it always appears that they're going the wrong way. So what did they do this week? These guys also went long more than they were, right? They increased their long. They were at 41 something, and now they're at 47.4. And they increased their short. So we would want to subtract this short number from this long number, because when you increase your long and your short at the same time, then your long wasn't as increased as it first appears. And look at their net position. They only have 47.4 long, but they have 57.6 short. So net, these guys are yet and still short in the Nasdaq. So let's just scroll on down, take a look at what that net short looks like. They are below the zero line. They have been reducing that short side exposure. And it seems like yet again this week, they reduced that short side exposure. So they increased their shorts, but they also increased their longs. And that's why they got closer to zero. It seems like they're trying to get to net zero. I remember what we were looking at a little bit ago, that when the market is really going down hard, these guys really like to get into positive territory. If we go back to like Corona time, right? Here, the 2020, we start getting into Corona. Things are getting really nasty, and these guys actually got above zero. Oh, wait, that's too far back, is it? No, that's good. Yeah. 2020. Early part of March, when we were at those lows, 2020. So when we see these guys going towards zero, or even trying to get above zero, it would almost make you believe they think the Nasdaq is going to go down. And the other group, the asset managers, well, it looks like they're betting that the Nasdaq is going to go up, because they took hedges off and increased their long exposure to the market. So they're bullish Nasdaq, they're bullish in the S&P. Sounds good so far. I like it. We're at all-time highs this week. We have to have some kind of assumption that, there was only one of two possibilities, that we would reject here and fade back to the 786, or that we would break out here and move towards the 1236. honestly, the alternate thesis was the breakthrough to the 1236. Now, maybe not so much. Maybe now the alternate thesis is fading back to the 786. But that's the Nasdaq and the S&P. I really don't dig too deep normally into the Dow, but that Russell has been sideways all year. And I've really been looking for an opportunity to run that thing. Make or break, I really don't care which way it goes. I just really want it to break and ride that thing. And I wonder if I'm the only one looking for that thing to make a move. The asset managers here, they took off a very large amount of their short side, their hedge, right? Compared to what they added, 900 contracts is what they added to the long side. They took over 5,500 contracts off their hedge. Now they were close to zero, right? If you take 209 and subtract 176, you'd see they were kind of close to zero, right? So let's just scroll down here and actually put it in a chart. Because for me, I don't know how you guys see it, but the lines help, right? I mean, I kind of think that it makes it easier to understand what's going on. I'm a quant guy. Don't get me wrong. I like my numbers. But I like being able to look back and kind of see how big this change is in relation to what they've been doing, right? That kind of helps put it into perspective. So we can see that they increased their position just a little, not very much. They made bigger moves before in other times, but they have been decreasing their position in the Russell since April, just this slow grind to the downside. And after hitting around 18,000 long, they've just really been kind of holding the line. So we're not seeing anything in here on the Russell yet, but I'm still going to be watching because, man, I would really love to run that Russell. A market that stays compressed builds energy, and the Russell has been running sideways for a long time. That thing is just winding up energy. Sooner or later, it's got to go. Right? I'm really interested in participating in that. So what about the leveraged funds? What's these guys been up to? They increased their long 3.2 and they increased their short 4.1. They are net short. We know that because they're 120 to the short side and only 50 to the long side. So we just scroll down here, turn on the leveraged money. Whoa, now this was a significant move to the downside between the second and third week of July. And this week, let's zoom in a little bit more. We can see that they just slightly increased their short, not by very much. They almost negligibly changed their position. They increased their short just a little bit. Okay, right? I mean that's what we got. It didn't hurt to look. I'm just keeping my eye on that Russell. I don't trade the Russell futures, but I'm going to be very interested in, the RUT and the IWM. There's a lot of small cap companies that I like to trade too. I'd like to see a little bit of shock and awe in there. That'd be nice. All right, so the dollar. If you guys watch my morning briefings, I talk about the bonds and I talk about the dollar a lot. So what do we got here? Asset managers are net long 99. We'll just call it 20,000. They decreased their long position in the dollar and they decreased their short. So they actually got a little more long. Not very much long, but they got a little bit long. They removed more short than they removed of their long. So it looks like they took some profit in the dollar. Let's just scroll down and see what it looks like, right? Turn off some of these squiggly lines. Yeah. Almost nothing, huh? From week to week, they went from 19.1 to 19.2. So they change. The change is so small, it's almost like nothing happened at all. But they are net long. They're less than 25,000. I'd say, for the last couple of weeks, we really just haven't seen them do much in the dollar. And I don't think that that's a bad thing. Let's just kind of stretch this back out a little bit. And think about the corona, right? Yeah, coronavirus in 2020. We kind of tagged the lows in early March to start to rally back up. That was a significant downward move in the overall marketplace. And they were sitting at around 20,000 long then, and they're sitting near 20,000 long now. We were at record lows back then. We're at record highs now. That's not really telling us that much, huh? What we can say is they really didn't change anything, right? We don't get hung up in gray areas, ambiguity, doubt, and confusion. They didn't do anything. Let's go see what the other guys did. Now, these guys, they took longs off the table and they took shorts off the table. Okay. They took more shorts off than they took off longs, and they are net long in the market. Let's see what that looks like. Let's scroll on back down here. Turn on the leveraged money and turn off the asset managers and zoom this in a little bit. Yeah, a little bit, right? They're above the zero line. In the last month, they've been making strides to the upside. And you can see how they go through periods where they'll make a good move and they'll kind of hold it for a few weeks, and then they'll make a move and then they'll hold it. So, maybe next week we'll finally start to see them make some serious changes, but not too bad. We're going to open it up a little bit and see what was going on back in the corona, just to kind of get a feel for where they were at. They went from, being almost flat to getting up around 17,000, 18,000. So it provides some context for them in the dollar. I'd say that both sides really didn't do that much. Okay, but, we didn't know until we looked. All right, so we're going to have to go over now to legacy COT. Any of them will work. It doesn't really matter, right? Which one of these? We just got to hit the button where it says legacy. So we'll just hit the one at the top. It brings up a different kind of grid like this. Now, at this point, I'm going to zoom out a little bit because we need to be able to see all the categories. Notice there's now two different Nasdaqs that we could look at, just like earlier when we were looking at two different ES markets. We have the Nasdaq Consolidated, and then we have the Nasdaq Mini. If you're ever unsure, you want the one that says $20 next to it, because we know a Nasdaq Mini is a $20 contract in the futures. From here, we can see the VIX futures. We've got the commodity index, which is great when we're trying to identify like inflationary metrics and things like that. But we're going to hit U.S. Treasury Bonds. Now, the groups kind of change a little bit here, right? Because it's just the way the government compiles this data. So we just want to scroll down to this area here. Commercial, non-commercial, and non-report. You and I would be like non-report. We don't need non-report. We don't need non-commercial. That leaves commercial, still net long, but still making that move to the downside. Okay, I mean, just we wanted to take a look, see where they're at. We're going to be looking at the bond charts here in a few minutes, but you can see that march to the downside all through 2021 and how we've been kind of stabilizing near these lows. And that when we zoom in here, the change between the last dot and this dot is very small. So they took a little bit off. That's it. VIX futures. Now, if you look at the VIX or the VVIX or all that other VIX products out there, they all refer back to the VIX futures. So you could just skip the middleman and look at the VIX futures. And again, the groups aren't the same as the groups that we were looking at before. So we just scroll down into this area, turn on off the non-report, turn off the non-commercial. That leaves the commercial. And you can see that they have been increasing their position in the VIX. Since September 20, they've been working their way back up to where they were between August and September, around that 96 area. So this was a significant change here, where they went from 90, call it 90,500 to 67,500. That's a heck of a change. And it seems like since then, they've been working their way back up. It always makes me suspect when I see something like this. Don't really know what to do, what to think about it, right? It's a significant move, but it is what it is. We just want to come in and just take a look, right? We're just trying to identify where the money's going. And if we can glean anything out of where we see them going with their money. To get a little bit of perspective, here we are right before the virus hit. And it was actually it was just a little side note. It was funny when we were climbing into all-time highs at the end of 2019, a lot of institutions took their insurance off. California took a lot of their insurance off of their pension funds right before the crash. And they weren't the only ones. I remember it stands out in my mind that a lot of those places were finding it hard to justify carrying insurance because we just had that monster march to the upside. And in late 2019, a lot of them started taking that hedge off. They weren't protected for the move down. And you can see how exposed they were through that move. But you could also consider that they were taking profit, right? Because during this move, the VIX exploded. It went to levels we'd never seen since they changed the formula. So, just a little bit of context, kind of put it into perspective. But they've been making these moves in the last few weeks, increasing their exposure in the VIX. It costs them a lot of money to hold these VIX futures. They would rather put this money somewhere else, right? We know that. So when they're putting it in here, and they're putting it to work here, you got to have some kind of bias to believe that they see risk out there. And it makes sense. We got Evergrande. We've got supply chain issues, chip shortages. It's a lot of things on the table. Oh, and the phrase I love to say, winter's coming. You Game of Thrones nuts. You know what I'm talking about. So that is the COT report. Now we can take what we just identified out of that COT report, and we can come over and take a look at the marketplace with it. Well, I guess this chart won't help you guys out. Let's see. Yeah, there we go. That'll do. So we got an new all-time high in the market. Talked about this Friday morning in the morning briefing before the market opened. It was very likely that we would set a new high and pull back. It wasn't, like some crystal ball reading. There was liquidity there, and it was doubtful that we would have enough buyers to absorb all of that sell side liquidity up there to be able to make it through on the first attempt. So we absorbed quite a bit of it, but one shot probably won't do. We're going to have to make another run at it, maybe two, until we finally get through it. On the other hand, we have two theses at this point. Thesis one is going to be that we pull back to the 786. You can see that would be the cyan line on my chart right around 43.53. That would be thesis number one. The alternate thesis would be that we go up to the 1236, and that would put us at 47.60 by Christmas. At least that's where I was sitting before I looked at the COT report. Now I'm really starting to think the other way around. Thesis number one would be that we go to the 123, and alternate thesis would be that we fade back to the 786. Either way, we're at a crossroads here. We will not stay at this point on the chart, right? We're going to go one way or the other. They increased their exposure to the ES, and that report came out on Tuesday. So Friday, Thursday, Wednesday, Tuesday at the close is when they reported their position changes to the government on that day right there. And remember, it takes them weeks and weeks and weeks to unwind a position and or build new positions. So we don't have to necessarily concern ourselves with the idea that, oh man, the data is 4 days old. What the hell? No, it's okay. Because week after week, when we start putting the data together in aggregate, it starts to make sense. They are still increasing their exposure to the upside, and they made significant progress on that this week. Now, the Nasdaq, on the other hand, they did the same thing. They increased their position, but we're not at all-time highs yet. We're still holding back. It looked like we were going to have a pivot to lean on. The good thing about it, I guess we could say, is that there was a pool of liquidity here, and we managed to get through it. It's gone now because we've crossed through that area. It is not there anymore. There is, however, still a lot of liquidity right here. So the old liquidity is gone. We've taken it off the board. There is no overhead resistance or support now. There is none. Volume nodes, yes, there is volume nodes now that will act as a support, but that liquidity is gone. Now we've got liquidity over our head, a ceiling that we're still going to need to work through. It looks like we got pretty close to it this week. So we're going to be continuing to watch for this move up. When we throw the fibs on, we're not yet back to 100, and we are in between. We're in the channel, the 786 100 channel. They increased their position, so they didn't hedge, they didn't protect themselves. They increased their exposure to an upward move. All right, we got the bonds. Now, to put it in a little bit of context, we're looking at a 20-year chart, and these are monthly candles. So it doesn't seem like very much, but we're looking at 2002 way back here and 2021 way up here. So we got a lot of chart to look at. And when I'm starting to see that head and shoulders a little more clearly every week. And when you're dealing with a head and shoulders, the really cool thing is that we trade the neckline break. Now, I've attempted at various times in life to catch it on the last pullback, the right shoulder. Sometimes it works, sometimes it don't, but yeah, something to think about. We definitely don't want to see the bonds break below that 154. I'm really kind of keeping my eye on that 157, honestly. On a smaller time frame, the 157 actually makes more sense, but we're at a critical juncture here. We don't want to see these bonds start breaking down below, definitely not below the 155. We start getting below that, and it's going to get pretty nasty out there. So every day during the day, I've got these bonds up. I'm watching their movement throughout the day significantly impacts our marketplace. So they're the best indicator you could put on the chart. US dollar. The other best indicator that you could put on your chart, that $90 area is a line in the sand I really don't want to see crossed. But if we use structure instead of just a value, that'd put us right around 88, 88.5. So kind of a line in the sand. When we start getting into the smaller time frames, like the daily chart here, you can kind of see it a little better. We do got some angular support. So we want to keep our eye on these. We don't want to see, anything drastic or extreme. When we do see drastic and extreme in the dollar and in the bonds, it impacts us greatly. You see the massive move in the market here the other day. And think about if you're trading the SPY or ES or Nasdaq, QQQ, think about what happened at 11 o'clock on 11:05 Friday. There's your 11 o'clock and 11:05 Friday. So hopefully you understand why we look at the bonds and we look at the dollar and how it greatly impacts our market, not just on an intraday when we're looking for trades, but overall in the marketplace, how we look at these and try to gauge our risk and our participation. The VIX, the VIX, the VIX, the VIX. We're still not back to the lows. Great time to be getting long in the VIX. Just bought some more calls in this last week, I believe. Maybe it was a week before. I've been buying calls in the VIX and selling put credit spreads against it. If the put credit spreads lose, it's probably because we're crashing and burning it, and the VIX is going to pay for it. If we don't crash and burn, the calls in the VIX are going to lose, but my credit spread and SPY is going to pay for it. Either way, I'm net short in the market all the time. And I do that with very little risk. Maybe I lose a couple dollars here and there, but it's like buying homeowners insurance, right? You lose money paying homeowners insurance, but you don't care because, if your house burns down, you want the insurance. Same thing. So we had a contract change event. That's the reason for the gap. No real cause for concern there. You do want to recognize, however, just come over to the options here and change it from active only to all, so you can see all of these, because we want to recognize if we are in contango or backwardation. If you're unfamiliar with that term, things that are farther away in time generally are more expensive. So when we have a product that has time and price connected to it, as we go farther out in time, it is usually more costly. And so closer in is usually not so costly. But it's usually a gentle slope. When we're in this slope or direction, it is contango, it's normal. But if it turns and goes the other direction, if it's inverted, where things close in are very expensive and things far away are cheaper, that's backwardation. We don't want to see backwardation. That would be bad. So I was talking about slope there for a moment. See if we could find it on the first shot. That is the slope that I was talking about. So we're looking at November, December, January, February, March, April, May, June. Now, notice May and June are starting to invert. Okay, I mean, that's a long ways out, but we're starting to see a little bit of backwardation there. Not too bad. Nothing to be concerned about. What is concerning is the steepness of the slope between November and December. That is extreme. And then from December to January, also a very extreme. Normally, it's a more gentle curve. It's kind of just eases in there. That is a very extreme curve. And we're going from 17 half to $25, right? That is a massive contango. Very steep, very sharp. For you options traders, it should give you insight. Because when you look along the right side of your tab here, you want to think about what that thing just said, that our volatility out here is way, way more expensive than our volatility up front. And that if you're selling options, you would be very wise to go farther out in time and sell options, because they're very, very juicy. Their cost is way higher than their value right now. And that you would not want to sell short duration options right now because there's no juice. Guys, I appreciate you showing up, this late on a Saturday to do a COT report. Hopefully you got something out of it. I ran the restream, so it should be on the Bullish Bears YouTube moments after I'm done, so you can catch the replay. And I will see you guys Monday in the large caps. Any questions before we go? All right, no questions. I must have done a good job. Take it easy, everybody. Enjoy the rest of your weekend.